Hi and welcome to Blue Bond Tax Planning. My name's Charles Delastic and I'm the Managing Director of Blue Bond Tax Planning. I've been a specialist inheritance tax planner for more than 18 years now, and we've helped hundreds of clients mitigate and usually eliminate their inheritance tax. So today's video is quite interesting because it's around one trust to suit everyone. We find for the vast majority of our clients, this trust is a default situation for them because it absolutely works and ticks so many boxes. So without further ado, let's cue the intro. Hello and welcome back. So today's video is all around one trust to suit everyone. So when I say everyone, is that actually everyone? Well, to be fair, that's probably pushing it because different people will have different circumstances. However, we find for the vast majority of people who are looking to place assets outside of their estate for inheritance tax purposes, this absolutely suits them and it absolutely works due to the massive amount of flexibility it has. So let's get into it. So first of all, there are many different types of trusts. So there are interest in possession trusts, there are discretionary trusts, there's immediate post-death interest trusts. They all have different benefits and they apply for different needs. And usually when we're planning for clients, it's a mix of all of these that help achieve the client's goals at the end of the day. But let's get into the one we want to talk about. So first of all, you'll find that many advisors will recommend a loan trust. So what does this do? Effectively takes a lump sum of money, let's call it 100,000, and places it into a trust, but it places the vast majority of the money, it places around about £10 as an actual settlement into the trust, but the rest of the £100,000 forms a loan to the trust. So what's the benefit of that? Well, very simply, it takes the growth of the investment outside of the estate. So immediately the growth arises, it's outside of the estate. So let's say you invested in a small company, if you were mad enough to do all of your investment into one thing like that, and it grew 15% in 1 year. That 15% would be immediately outside of your estate, but the loan continues to stay in your estate until you die or unless you remove the loan from your estate. So it's always a loan and you can always get your money back, and therefore it does give some degree of flexibility for people who are looking for their capital back again at some point. Usually why? Because they're afraid about going into care, but at least it stops the problem getting worse. That's the beauty of a loan trust. Next is a discounted gift trust. So what does a discounted gift trust do? It effectively places the money outside of your estate. Now, you can get a discount on the amount of tax that's payable immediately, and you can actually place more than £325,000 into this particular trust without immediately triggering a immediate tax of 20%. The complications of it, you don't really need to get into it, but you can. But the main point about this is we tend to call it a fixed income plan because you have a bond, usually offshore or onshore, held subject to a discounted gift trust, which allows you to take 5% a year from that trust. But because that's a return of capital, that is not taxable when the money comes out. Now, if you take any more out of that, there's an issue because you can't alter the terms of this particular trust. It's very inflexible. Once you put the money in, you get a fixed income stream, whether you need it or not, and therein lies the problem with a discounted gift trust. But of course, one of the benefits is that you can get more than £325,000 outside of your estate. But if you've got no need for an income stream, then really it doesn't say, or you want a more flexible income stream, that really doesn't suit. So that's the issues with a discounted gift trust. Okay, so what's the trust that I think absolutely works? It's a flexible reversionary trust. Now, this is a type of discretionary trust. In other words, the trustees do have a right to adjust how the money goes to the beneficiaries in the long term when the people settling the trust eventually die. So if when you place the money into this trust and then you die, the trustees, to be fair, when we do it, it's normally the children, have a right to determine who gets what from that trust because it is a discretionary trust. Okay, so how does it work? Okay, so first of all, it's a single settler trust. Yeah. So in other words, one person only puts the money in. Now, if you've got a couple, we would normally suggest that they both take one out each out. So let's say they can afford to put £500,000 outside of their estate, or that's what they need to do for inheritance tax purposes. So they would both do £250,000 each because it's a single settler trust, and that gives it additional level of flexibility. So what happens is you take that amount of money. So in this example, let's say it's £210,000 that a person has placed outside of their estate into this trust. If they do nothing else, and in the vast majority of our clients' cases, they don't actually ever touch it ever again, after 7 years, the whole sum is outside of the estate in the normal way of a trust gift, right? So what happens is you take that 210,000 and you split it into 7 blocks, yeah? And each block is worth 1/7 of that 210. So obviously that one's worth 30k, that one's worth 30k. They're all worth 30k effectively. So what happens is that every single year you get a reversion back to the settler. That's why it's called a reversionary trust. So you are entitled to get back your 30k every single year. Now, in the vast majority of scenarios, obviously in the first few years, you wouldn't be taking it out because if you felt you had a need, you wouldn't put that much in the first place, right? So effectively, you get the choice. That's the point of accepting that reversion or not. Now, as in the vast majority of cases, every single year, the clients don't want the money back. All that happens is that 30k goes on the end of the line. So every year, it just adds in. Now, let's just say you get a time where you think, okay, I want to take this world cruise or whatever, and you want some money back. It is possible to stack one on top of another. So in 1 year, you could take out 60,000, right? So that makes it very, very flexible. Now, the issue is whenever the money reverts back, it has 2 elements. It's the original capital and it's the growth, right? The original capital is tax-free. The growth is subject to income tax at your highest marginal rate. So that's how that works effectively. You can't split it. They're vertical slices. But you don't have to take the whole 30k at any given time. You can take out pretty much whatever you want. So any figure from £1,000 up to £30,000 in any given year, right? Now, if you've got a couple doing it, of course, and they both put in 210, every few months they've got the ability of having £30,000 coming out or less, depending upon what they want. So really, really very, very flexible. So if a person wanted exactly 10,000, we would work out what element of growth there was and what element of capital was back. They'd have to pay a bit of income tax. So if they have to pay an income tax, we take out slightly more than the 10,000 to allow for the income tax on the growth, thus giving them a net £10,000. And that's flexible enough for that to do that. So you can see that works really, really well because it's better than a loan trust because all of the money is outside of the estate after 7 years. It's better than a discounted gift trust because you've not got a fixed level of income. That's the point. You can take out what you want and you're not limited. You're only limited to 14.28% actually, which is 1/7 of the original capital you put in plus the growth. So that's bigger than the 5% you're allowed to take out of a discounted gift trust. So for us, it's better than both of those plans for the vast majority of people. So what are the benefits? Okay, so the first benefit is, as we've said, it's highly flexible. You can take the money out or not take the money out as you choose to. Yeah. The second benefit, the return of the capital is 14.28%, not 5%. So you can get a bigger lump out should you need it, is the main point. Third benefit is you can hold less assets. So why do people put the money out and still want the capital back? Well, usually it's because they're worried about if they go into long-term care, right? And therefore being able to get all your money back over a period of 7 years, and the vast majority of people who go into full long-term care, to be honest, don't live 7 years in a home. Alzheimer's is changing that statistic to quite a large degree. But you will have the ability of getting all of your money back within 7 years. And that's the benefit, as opposed to with a discounted gift trust, which pays you 5% a year, which means that it's over 20 years, not over 7. Big, big difference. Okay, so therefore you can hold less assets because you have the capability of getting back your money in its entirety quite quickly, and therefore you can hold less assets in your estate, which might then reduce your inheritance tax because of the flexibility of this particular plan, right? Okay, and then the other benefit is obviously you can do two lots of 325 each person if you're a married couple, for instance, therefore 650. What happens when the first person dies? Well, because they're single settler trust, the spouses are beneficiaries of the trust. So when the first person dies, the other spouse as a beneficiary is entitled to all of the money. It would still pay income tax on the growth element, absolutely, as you do with any investment. You have to pay tax on the growth. But they're entitled to the whole lot. They don't have to take it out in the small blocks. They could literally take the whole 210,000 plus the growth in one fell swoop. So again, that makes it highly flexible and makes it sensible to have two trusts for a married couple. So that's if the first person dies. Okay, so basically, my perspective on this particular trust is that you can have your cake and eat it. Because the other methodologies mean that it's either not outside of your estate with a loan trust, or you've got a fixed income stream which you haven't got any control on the discounted gift trust, and you can't alter it and take out additional capital if you want. This gives you the best of both worlds. You can put your money out of your estate, you can have the whole lot back, the only negative being that you can't have it all back in 1 year. That's the only issue. But for most people, that makes complete sense. So does it suit everyone? Well, yeah, maybe not everybody, but if what you're looking to do is to place a large sum out of your estate, make sure it's secure, make sure you get the benefits of a discretionary trust and still have the ability to have all your money back within a 7-year period, that as a trust is an exceptional solution and will suit the vast majority of it. So give us a call if you're interested in this. This is not something that a lot of financial advisors even know exist, let alone anything else. So we'll explain it to you, we'll help you deal with it, we'll help you eliminate your inheritance tax. Give us a call. If you like that video, also give us a like down below, and if you're really interested in inheritance tax, then subscribe to my channel, because there's a lot more of this kind of stuff that we'll be talking through. Thanks, goodbye for now, and thanks for listening. Bye, thanks.